Flashcard number 3, we're examining the cost of decision making. And so we're going to look at a case where we have the RL10 acting as the proxy for price that's engaged in this channeling trending upward behavior. It has moves up, consolidation zones on pullbacks, finds support, makes a strong move up, pullback, consolidation, makes a strong move, keeps going up. We have a series of higher lows. And so the typical decision making that occurs inside of typical price action like this is once I'm in at the green dot and I've identified maybe the Bollinger Band 1 and 2 as my 2R targets, I'm long, I get past my price target, and then price starts to hesitate and fade and fail. And then the RL10 quickly rolls over, and now I have these decision points. Am I going to preserve my win at position 1, 2, 3, 4, and maybe this is where I've given back a certain amount of the maximum favorable excursion. Or do I give it back at 5, 6, 7, 8? And then once it finds support here at a position higher than my entry, and now I've got a resumption of a trend. How much do I let it go before I'm confirming in my mind that I'm certain that the resumption has occurred? Do I re-enter at 1, 2, 3, 4, 5, 6, 7? If this was the previous swing high, do I really want to get in at 7 since that's the last place that it failed? But if I know that if it breaks through that line, then the move from 8, 9, and 10 is pretty quick, because this is where everybody that's short this instrument has placed all their stops. And so if it breaks through that barrier and hits those, there's often a quick pop. So there's an argument that I want to be into the position before it hits those stops so that I can take advantage of all of the pop and I'm not trying to chase a trade. What I want you to think about is how important is it for you to be right as opposed to make money? The reason not to get out at 1 in your mind is that, well, if it just hesitates there and then takes off, then I would have been wrong that this was just a pause, and I would have been wrong about that being the end of the run, and then I would have to re-enter, and then I'm worried about the cost of getting back in. And so for that reason, not wanting to be wrong and trying to save the cost of the round trip, we wait. And then the longer we wait, the harder it is to get out until we get this emotional charge that finally says, oh, I'm watching all my profits evaporate. And in some place between 1 and 8, that tension is resolved. Now, maybe I have a rule that says I'm willing to give back 1/3 of the maximum favorable excursion, and so I might have a rule that tells me at what point I must mechanically get out. I may have picked a trailing stop that does that for me. But one of the things I want you to notice is that in a series of upward trending swings like this, where you're getting in, exiting, getting back in, exiting, that not only should you be paying attention to what you net in the green, so buy and then sell, I net this. And then if I re-enter here, I'm going to net whatever I get based on my exit. I also want you to start looking at the cost of that feeling of certainty. You need a certain amount of evidence to make you feel confident that you're making the correct decision, that you're right about that being the end of the move. I'm giving it room to run and to decide. What's the cost of doing that? So in this case, the cost of doing that was I got out here, so I gave back all of this move from the top of the green box to here, and then I didn't get back in until here. So I'm actually giving up the size of the yellow box, which in this illustration is the size of the favorable trade. So if you study where you're getting out and then getting back in on these continuation patterns, you can start computing the expectancy of your typical yellow box. And that will tell you what you're routinely paying for confirmation and the need to be right. Now you should compare that box, what you're giving up, compared to what you're actually netting, and decide this should be much smaller than what you're netting. If it's more than 1/3, then there's room for you to be improving your exits and your reentries. If the cost of reentry is relatively small as a percentage of dollars at risk, then pretty soon that goes towards zero. That has zero effect. Now, if I got out at 1 and then watched this thing muck around for 20 minutes, 30 minutes, 40 minutes, 2 hours, and then it went through the blue line, I would feel justified in getting back in. But what if it only did that in 2 seconds? If I get out at 1 and then 2 seconds later it goes back through the blue line, I still want to buy it at that price. It's making it all an intraday new high. And the only difference between those two scenarios is the amount of time in between the two decisions. That's not something I can control. That's something driven by price. And there's no way that I can estimate what that length of time is likely to be or the probability that it happens. And so we're attributing power to ourselves that we really don't have, the ability to forecast the future. So learn to get rid of that time dimension in between those decisions and make that a value neutral or an emotional neutral impact. It simply is a price level. So what I like to do is if I exit at 1, I immediately draw my re-entry line so that if it then spikes up through, I'm back into the trade. And then I stalk the trade down 1 through 8. I've made a decision based on the 2-hour battle drill whether or not I actually want to stop and reverse if I'm willing to play the trade from this extreme condition back to the Bollinger Band mean. If I'm not going to make that short decision to stop and reverse, then all I'm doing really is stalking a re-entry as it proceeds down through the stations here 1 through 8, and I'm looking for to find support in a 1, 2, 3 entry so that the swing low is higher than the previous swing low. And that gives me a belief that the trend is still in place. And now if I can exit at 1 and re-enter at 2, then I have reduced the size of the yellow box and the expectancy of my confirmation bias is small. So by engineering and shaving down these locations, you can actually increase the size of your yellow box. Require just a little bit less information that the trade is failing. Get paid more often, and high at a higher rate, and be willing to get back in. Be willing to tolerate being wrong. I look at it this way: I expected to be wrong anyway, so if I get out and then immediately 10 seconds later I'm back in, then I feel like I get to be wrong and I get to be back inside the trade that's moving in my favor. So examine the cost of decision making, flashcard 3.